we came into the year and there were expectations in the market that the Fed might cut rates in 2023. We've been watching our portfolio very closely. We see a very broad segment of the corporate market in the U.S., both on the credit side and in other parts of the KKR business. And growth was just exceedingly strong, or I should say much stronger than what we expected coming into the year. That perception in the market that there would be Fed cuts in 2023 was something that I think we arrived more quickly than the market to the view that was unlikely to happen. As we go forward, I think we're of the view, which is more in line with the market today, that the Fed is closer to done. There might be another 25 basis point hike, but I think we're nearing the end of this hiking cycle. And so I think from processing the acute pain of a very short-term rise in rates on the short end of the curve, we're nearing the end of that. I think the growth that we're seeing in the economy continues to be very strong, and we have not yet seen the labor market really weaken, which I think is going to be a big important factor in terms of when you start to see potential Fed loosening. But as of today, it feels like there needs to be more weakness in the economy before the Fed's going to pivot. So I think we as a firm are seeing opportunity generally. Credit is a really attractive asset class to be in right now. Not only have we seen more spread on the private credit side than historically has been on offer, but we're also seeing better structure and bigger businesses coming to the market. One thing that I think is really important is in private credit, bigger businesses with lower loan to value are paying you more to access that market with higher base rates. And so you're getting really solid return expectations on lower risk. I think the big question in private credit is ultimately is the syndicated markets reopen, how long are those returns sustainable in the market? It will be a question of just the duration of the good vintage that we're feeling today. It's really a question of the market, the health of obviously the private credit market, the syndicated markets, just the capital markets in general. It does feel like we're going to be in a choppy environment for a sustainable period of time, and so I think I'm optimistic that there'll be an outsized opportunity for the foreseeable future in both of our markets. But that is a question. Whereas if the syndicated market really recovers quickly and cost of capital becomes lower there, issuers are going to be incentivized to refinance expensive debt that they may have placed in the private markets. So I think the biggest thing from a macro perspective that we're debating as a team is when is the right time to start to add duration in the portfolio. Clearly there's been a lot of disruption, and in particular the fixed bond market from the changes in cost of capital. We are more, I mentioned earlier that we had the view coming into the year that the market was probably expecting cuts too soon, and so we favored floating rate loan exposure over bond exposure, all else equal, because you were getting compensated for rates continuing to stay high and rising through this Fed hiking cycle. With the market now more in line with our perspective of higher for longer, we're starting to see more opportunity to add bond exposure. I wouldn't say we're at the moment where we're outright wanting to take duration risk, but I think our view of the asset classes has come more into balance. Really what our KKR macro team has guided us to, and we support from the credit investing perspective, has been the real leading indicator of when to start to take duration is when you start to see the labor market weaken in the U.S. Well, I think what we're seeing in the market today is one where we're just in a step change difference in terms of the return on offer in credit. I think one of the really important things to understand about the credit market is that in particular in the bond market, the quality of issuer taking advantage of the bond market has gotten a lot higher quality over the past decade than where we had been. The average percentage of the market that is BB rated, the highest rated portion of our high yield market, is 50%. In the European market, that's 60%. And more of the market is coming to, more and more of the issuance in our market this year has been secured. It's about 60% year to date versus a historical norm might be closer to 15%. And so we're seeing a market that's becoming much more high quality. And as a result, we're not only seeing kind of return, but we're also seeing higher quality businesses access that. And so I think from a market opportunity perspective, we really like that dynamic. Clearly there's risk in the macro economy, geopolitically, et cetera. But we are seeing opportunity, really doing the simple things right now.